Alright, let's get real. Your wallet's about to feel the heat, and it's not just inflation. High interest rates are flipping the game on everything we know about saving, spending, and investing. Think your old money habits are going to cut it? They won't. Here's the deal. A high-interest world changes everything. Borrowing gets pricier, saving suddenly feels rewarding, and investing? Yeah, it's a whole new ballgame. But don't sweat it. I've got the playbook to help you navigate this chaos. In this video, we're diving into the strategies you need to thrive in a high-interest economy. From supercharging your savings to dodging debt traps and making smarter investment moves, this isn't just about survival. It's about thriving. Stick around because getting this right, it could completely change your financial future. Let's go. Understanding the high-interest economy. A high-interest economy refers to a period when central banks set interest rates at elevated levels to control inflation and stabilize economic growth. These higher rates typically affect the cost of borrowing and the returns on savings and investments. In 2025, it's anticipated that central banks in many parts of the world will maintain high interest rates due to persistent inflationary pressures and efforts to prevent an overheated economy. Why interest rates matter. Borrowing costs. High interest rates mean higher costs for borrowing money, including mortgages, car loans, and credit card balances. This can lead to reduced consumer spending and borrowing, as people are less likely to take out loans when they face higher repayment costs. Savings returns. On the positive side, savers benefit from higher returns on savings accounts, CDs, certificates of deposit, and other interest-bearing accounts. Banks often raise the interest rates they offer on deposits to attract more customers when borrowing becomes more expensive. Inflation control. High interest rates are typically a tool used by central banks to curb inflation. When borrowing becomes more expensive, people tend to spend less, leading to a reduction in demand for goods and services. This can help lower prices and bring inflation under control. Investment strategy. Investors may adjust their portfolios in response to changing interest rates. High rates can negatively impact stock prices, particularly those of companies with high levels of debt, as they face higher interest payments. Conversely, bonds and other fixed-income investments may become more attractive as their yields rise with higher rates. Strategies for saving money in a high-interest economy. 1. Take advantage of high-interest savings accounts. One of the most straightforward strategies for saving in a high-interest environment is to focus on high-yield savings accounts. These accounts offer better returns than traditional savings accounts, helping your money grow faster without exposing it to risk. Look for online banks. Many online banks offer significantly higher interest rates than brick-and-mortar institutions. These accounts often have fewer fees and more attractive terms. Consider money market accounts. Money market accounts often offer higher yields than regular savings accounts, though they may require a higher minimum balance. Use certificates of deposit, CDs. If you can afford to lock your money away for a fixed period, CDs can offer even higher returns. Be sure to compare rates across different banks to find the best deal. 2. Refinance or consolidate debt. In a high-interest economy, the cost of carrying debt becomes more expensive, especially for credit cards, mortgages, and personal loans. Refinancing or consolidating debt can help lower your overall interest payments. If you have a mortgage with a variable interest rate, consider refinancing to lock in a fixed-rate mortgage. Even though mortgage rates are high, locking in a rate now could protect you from further increases in the future. Consolidate high-interest debt. Credit card balances can carry high interest rates. Consolidating multiple debts into a single loan with a lower interest rate can reduce your monthly payments and save money on interest. Pay down high-interest debt. If refinancing isn't an option, focus on paying down high-interest debt, such as credit card balances. Paying off high-interest debt quickly can prevent it from snowballing and costing you even more in the long run. 3. Focus on reducing unnecessary expenses. In times of high interest rates, managing your spending is crucial. Reducing unnecessary expenses will free up more money to save and invest. Track your spending. Start by tracking your monthly expenses. This will help you identify areas where you can cut back. Consider using budgeting apps or tools to monitor your spending habits and set realistic savings goals. Take a closer look at your subscriptions, streaming services, gym memberships, magazines, and cancel those you no longer use. Even small savings can add up over time. When making purchases, especially large ones, look for discounts, shop during sales, and consider buying second-hand items. Be mindful of your spending and look for ways to get the best value for your money. 4. Invest in inflation-protected securities. With inflation continuing to be a concern in a high-interest economy, consider investing in assets that are designed to protect your wealth from inflationary pressures. These government bonds are designed to keep up with inflation. As inflation rises, the principal value of TIPS increases, which can help maintain the purchasing power of your investments. Real estate can be an effective hedge against inflation, as property values often increase with inflation. If you're looking to invest, consider buying properties in high-demand areas or those with potential for appreciation over time. Gold and other precious metals are often considered safe haven assets during periods of economic uncertainty and inflation. They tend to hold their value and even appreciate in times of financial instability. 5. Build an emergency fund. A high-interest economy can bring increased financial stress, so it's more important than ever to have an emergency fund in place. Having money set aside for unexpected expenses will provide peace of mind and prevent you from relying on credit cards or loans during tough times. Start small. If you don't have an emergency fund yet, start by setting aside small amounts each month. Aim to gradually build up a fund that can cover at least 3 to 6 months' worth of living expenses. Use high-yield accounts. Place your emergency savings in a high-yield savings account so your money earns interest while remaining easily accessible in case of emergency. 6. Diversify your investments. In a high-interest economy, it's crucial to diversify your investments to mitigate risks and capture opportunities across different sectors. While high interest rates can cause volatility in the stock market, there are still opportunities in specific sectors. Look for companies with strong fundamentals, minimal debt, and solid earnings potential. Dividend-paying stocks can also provide a steady income stream. As interest rates change, your budget should evolve. Reassess your income, expenses, and savings goals periodically to ensure you're adapting to the current economic environment. Adjust your investment portfolio. As market conditions shift due to higher interest rates, consider rebalancing your portfolio to reduce risk and capitalize on opportunities. Stay informed. Keep up with economic news, interest rate decisions, and market trends to make well-informed decisions. Saving money in a high-interest economy presents both challenges and opportunities. By taking advantage of higher interest rates on savings, managing debt effectively, cutting unnecessary expenses, and investing wisely, you can improve your financial situation and build long-term wealth. The key is to stay disciplined, stay informed, and adapt your financial strategies to the evolving economic environment. By doing so, you can navigate the high-interest economy of 2025 and beyond with confidence and success.